We are joined right now in the studio by two guests. We're going to talk about the futures being lower, the dollar being higher, S&P Moody's warning they may downgrade Greece's debt rating. For more on sovereign debt worries, we are putting together a roundtable. Keith McCullough, CEO of Hedgeye Risk Management and a Bloomberg TV contributing editor. Todd Harrison, founder of the well-known financial blog Minyanville and a former Wall Street trader. Todd, we welcome you to the newsroom here. You say we've gotten here by 5 steps, which sounds a lot like the natural grieving process that we all go through with loss, right?
Well, we are going through a grieving process, and it drew the analogy between the denial, sadness, anger, bargaining, and acceptance. But I think going back to how this played out during the first iteration of the financial crisis, our government effectively bought the cancer to sell the car crash, or they inhaled a tremendous amount of toxic debt to stave off a financial collapse. But they didn't, the financial crisis didn't disappear, it simply changed shape. And so we drew the analogy, what if Greece is Fannie Mae and Portugal is AIG and Spain is Bear Stearns, and if it plays out that way. So risk isn't actually being destroyed, it's just moving and changing shape.
So, Keith, with this in mind, I mean, what's the average investor to do? Best advice?
I think you have to be really careful about duration, because now it's starting to be, headline news every single day. And we called it, sovereign debt for dummies the other day, because not everybody is a professional in understanding this. Like, for example, this morning, people are freaking out because Moody's and S&P are going to downgrade the debt. Well, they're a lagging indicator classically. So you want to be careful with your euro short position, for example, if that's the way that you've been playing this, which we have, in terms of marking that from a sediment perspective.
But you've also pointed out in your research as well, managing risk is not just managing to the downside, it's also managing to the upside. Right. And you raise sort of a basic question saying, if defaults are at all-time lows, but issuance is at an all-time high, I mean, how does it end?
Right. In the end, it ends very poorly. And anybody with a college education at this point can figure this out, because what you just said is not, it's not that complicated over the long term. I think what's complicated is managing this risk on a day-to-day basis. And what you really have to do is use consensus kind of as a backboard to trade around it.
All right. So, Todd, how do we get out?
Well, I think he hit the nail on the head. It's the destination we arrive at versus the path that we take to get there. I think ultimately you need to see debt destruction. I mean, that's where we have to arrive at eventually, is to see debt destruction, because there's too much. In many ways, the cancer is bigger than the global economic patient, and we're coupled together in the world with 500 some odd trillion dollars tying the world together. So you need to see that debt destruction, and and if we can get there, it'll be a painful pill, but it'll be medicine as opposed to drugs that mask the symptoms.
Bloomberg ran a story about Harvard's Rogoff saying he sees a bunch of sovereign debt defaults to come. Give us some investing tips for the dollar, Keith.
Well, from being long the dollar is probably the easiest way to universally capitalize on this, because you basically all the improprieties of the European system from a currency perspective. You get to capitalize that on the upside, fairly low beta way. To address Rogoff, though, I mean, you got to be careful from a sediment perspective, because not unlike Ferguson or Rubini, these academics tend to
groupthink.
Right, you tend to kind of crowd in with these academics at the bottoms of moves, and I think the euro right here at $1.34 is actually oversold. So to some extent, Rogoff is a bit of a contrarian indicator right here now.
But I would also point out that the carry trade is on in size in the institutional space, right? So last year, the dollar, everybody hated the dollar, zero interest rate policy.
Yeah, Keith was in with the burning buck.
Right, so everybody piled into this carry trade, and the dollar is up 8%, I think, off the December lows. So if the dollar continues to catch a bid here and the European disunion could effectively lend to that, then you can see an unwind of this carry trade, and that can lend pressure across the commodity and equity space.
What do you think Bernanke can say today that changes anything for the dollar?
I think you take everything with a grain of salt. I think, you're between a rock and a hard place here. And this is not, I think the key word here is cumulative. This is not something that you wake up one day and you read in the paper. This has been building since the back of the tech bubble, when we were never allowed to enter recession. It became an anathema almost to say that we're in recession. And we were never allowed to go through a natural business cycle. So it's been cumulative. It's been growing. We've seen it through the credit creation. And we have to take that medicine as opposed to synthetic masking of the symptoms.
And really quickly, I mean, as you pointed out, the media focused on more Spain, focused on Greece. We should also be paying attention to the Middle East, since we're talking about sovereign debt. Right,
and the Middle East has been really, underperforming from an equity perspective, despite oil hanging in there at around 80. So that's just a reflection of more of the same, because Dubai's really kicked the can down the road from a sovereign debt perspective. They said that they're basically not going to tell you anything till the end of March, and that's just not good enough.
All right, thank you very much, Keith McCullough and Todd Harrison.